Okay, so this is a speech about China's economy, and it's really straightforward. There are a couple of more economic terms. The first one that's going to come up is the GDP deflator, which I'm going to give you the definition because I hadn't heard the term before. So it's a measure of the level of prices of all new domestically produced final goods and services in an economy. And in Italian, I believe it's the deflatore. I'm probably saying it wrong, but what I found on Wikipedia was deflatore del GDP. And then the second one, which is going to be at the end, also something that I had to look up, is fiscal pump priming. So, that's not right. So pump priming is basically the idea that the government has to introduce measures to stimulate the economy, like a pump which has a valve, so you have to activate it. And I think something that might be useful if you want to get around the term, which is more technical, is just azione di stimolo, because that's basically what it is. Okay, so I'm going to get started now. Now, in the past few years, China's economy has, of course, experienced an overwhelming amount of growth, but recently it seems to be slowing down. However, some people disagree with that idea. It ought to be an obvious point, but it bears stating at the outset that China's growth remains strong. Its economy expanded 6.7% year-on-year in the second quarter, and that's exactly level with its first quarter pace, so things are still going well for China. Coming off last year's stock market crash and the surprise depreciation of the yuan, many had expected the economy to swoon this year. Some people have even talked about China falling into a recession in mid-2016, i.e. now. But we are more upbeat about its growth prospects for this year, if not over the longer term, and that's the important part. Now, as ever, the veracity of the data is open to question. There has long been evidence that the Chinese government sometimes fiddles with its figures to make things easier for itself. Last year, it seemed to be playing with the GDP deflator, depicting real growth as stronger than it actually was. But a big jump in the deflator in the second quarter is more closely aligned with real price movements in the economy. And so that suggests simply that reported growth from the government is closer to actual growth. There are also a lot of other alternative indicators that support this view. There's been a surge in investment in infrastructure, the property market has had a strong first half this year, and personal consumption on everything across the board has been buoyant. Now, the new worry then is not that this growth is not happening or that it's slowing down. It's that the reasons behind that growth are not sustainable. Investment accounts for nearly half of GDP, and that's something that can't go on forever. In recent months, in fact, the growth of the economy has been almost entirely powered by the state. The slowdown in private sector investment has been astonishing, from growth of more than 40% in 2011 to just 2.8% in the first half of this year. A wide range of industries are experiencing troubles with overcapacity and businesses. Private businesses in China are worried about the future, and that means that they're holding on to their cash instead of investing. And of course, because they're holding on to that cash, the state has had to step in, and its investment spending is up 20% so far this year, double its 2011 rate. Without the government's big push, the economy would be much frailer. So essentially, you can see that this is a bit of a house of cards. The economy is growing, but it's absolutely being propped up by the government. The government-led approach is simply not sustainable. the state-owned companies leading the investment charge are both highly indebted themselves and much less efficiently run than their private sector peers. And so by relying on less productive firms, the overall economy is becoming less productive. China's growth model has become more costly, is how an economist with the Royal Bank of Scotland has described it. Now, the optimistic scenario is that this shift to state-led investment is only temporary, and that the government will soon take a step back when businesses rediscover their power. Private companies have done a good job of paring their debt levels in recent years, giving them more space to increase spending. And an upturn in profit growth in recent months is the kind of sign that usually points to a pickup in investment. So that's it for the more optimistic side. But the more pessimistic view is that the problems of private businesses run much deeper than just getting their power back. Stunted reforms to the state sector have sharply constrained the areas in which they can hope to grow. Finance, energy, telecommunications and transportation are virtually off limits. And moreover, the areas in which these private businesses can operate are still suffering from overcapacity. The huge amount of unsold homes explains why property investment is already slowing, despite impressive sales in the first half. We might say that China's growth has been so fast that it simply can't go on in this way. And so, if this pessimistic view is right, and things just are too frail for the economy to pick up, it will take more than fiscal pump priming to unleash the private sector. China will need to get down to the business of shaking up its state firms, making them more efficient. But while we were confident in forecasting that growth would fare well this year for the Asian giant, that idea of a state sector reform is more of a pipe dream than a possible reality at this point. Thank you very much.